We have a lot of clients who have generated a lot of wealth that is sitting in the family trust structure.
Yep.
Let's hypothesize for a moment they put an apples for apples comparison between having their wealth in a family trust structure or an investment bond structure. How do they differ?
Yeah, so in a family trust, the reason why you set up a family trust is you want to be able to distribute the earnings, so that the money's accumulating there, and in a family trust you have to pay the distributions out. And ideally you want to be paying them out to someone who's on a lower marginal tax rate. Okay, that's when it works. Now, don't forget, it doesn't work for minors. So the government under Kevin Rudd brought in a rule around minors tax. So if a child's under the age of 18 years of age and they unearn income from a family trust, they can be paying tax as high as 65%. They can make about $400 a year.
It's $416.
Yeah, which is nothing.
Nothing.
So
it used to be about 10 times that.
Oh, it used to be great.
About $4,000 before that.
You could give your 5-year-old $5,000 a year and fantastic, but that doesn't work anymore. So then you're really talking about children over the age of 18.
Yeah.
Now, if you've got a child, I've got a child at university doing vet, it's a 6-year degree, that's fantastic. I can distribute money to her. She's on a lower tax bracket. But then once your child gets up to 25, 26, 27, and they're earning a good income, then they're on that tax rate of over 30% anyway, and they don't really want to be having that distribution. So family trusts really work if you've got children in that certain area, and if you don't have children in that category, then it doesn't work. Now, of course, you can distribute money to your partner if they're not working, but we're seeing a lot of people today, certainly most people today, with the cost of living, etc., where both partners are working and paying tax. So the family trust only really works if you've got someone on a lower tax bracket to distribute the money to. Otherwise, it's not really serving any purpose. The other thing with a family trust is it does work well if you've got hard assets. Investment bonds can really only invest in managed funds and ETFs. So if you do have, a lot of people might have their business premises or residential property in their family trust, you can't do that in an investment bond structure. But what you can actually do in a family trust, which many people don't realise, is, as I said before, any earnings in the family trust have to be distributed. Now, you might go through a period for 10 years where everybody's on a higher tax bracket. You don't want to be distributing anything. So you can actually put an investment bond within a family trust. So an investment bond can be owned by an individual or an entity. Now, investment bonds don't distribute any earnings, as opposed to a trust, which has to distribute its earnings. So if you get the money in a family trust, you put it into an investment bond, it keeps the earnings in there. You don't have to make these distributions to people who are on the higher tax bracket. And after a 10-year period, you can then distribute this money with no tax consequences to the individuals, regardless of their personal tax rate.
Yeah.
So it's a little bit of a complicated answer, but I think family trusts are something in this country that get overused. And the Labor government, who are going to be in power for a fair while, if you look at the last election results, they've already stated they're coming after family trusts. Yeah. We also have specific rules in family trusts where distributions have to be going to the beneficiaries. And I think there are people out there who have family trusts where their accountant does an entry that says, you know, little Johnny got a distribution, but in actual fact, little Johnny didn't get the benefit or the distribution. So there's going to be crackdowns on family trusts. And that's why we say that you really want to not just diversify by asset class, but also diversify by structure. Have a bit in superannuation, have a bit in an investment bond, have a bit in a family trust. But if you've got all your money in that one particular structure and the government legislation comes along that makes it less favourable or puts it under greater scrutiny, you may find yourself in a situation where you're unwinding properties, etc., which can be quite expensive to do. So I really think it's horses for courses, and I think you want to be spreading your money around to minimise that legislative risk around taxation.
Why have investment bonds not taken off in the past the way other structures have?
Yes, I guess they're unheard of. Back in the 80s and 90s, there was billions and billions of dollars in these things.
The old endowment policies.
Yeah, we used to be the old over 50s group, and we had $8 billion in funds under management before funds management existed as a word in this country. So we're actually a friendly society, and friendly societies go back many hundreds of years in Australia. What really took away the popularity was the flexibility of superannuation. I remember a time where you could put $1 million. The government was encouraging you putting up to $1 million in superannuation contribution. Now they're saying you've got a cap on contributions. So it's funny how things change, aren't they? And the money that's gone into superannuation, you could access it at 55 at one stage, which was very flexible. So if you had that flexibility in superannuation with self-managed super funds, don't forget, before Keating introduced the rollover, There was no such thing as a self-managed super fund. People worked in the railways or they worked as school teachers and they never thought about their superannuation. It was something when they retired they got an income stream from. But all of a sudden, super became really flexible. You could do all sorts of things with it. And then more recently, the government strangled it and made it less flexible. And as a result, people are looking for the next best option.
Michael, let's touch on Division 296, which is probably one of the catalysts for why the investment bond conversation has really picked up again. We're not so much concerned about Division 296 today as what we potentially are 5, 10, 15, 20 years down the track. The fact that the capital gains are not indexed, or the growth of the super fund is not indexed. Some conjecture around how much is actually being taxed and how much is not. If they've gone this far, how much further can they go? Talk about in the next 15 to 20 years, when you retire, you may not even be able to withdraw your super as a lump sum. You may be required to draw it as an income stream. All these things have certainly led to people having discussions with their advisors around, let's consider alternative options. We've spoken about putting the money in the bank. We've spoken about putting them into managed funds and term deposits. We've spoken about setting up separate companies, separate entities. Let's talk about investment bonds. On the assumption that if we can maximize as much as we can in the super environment and come to a stage where for those who it's important, they don't want to exceed the $3 million threshold. Generally, for those who sit in the 47% tax bracket, inside super and outside of super, you're probably going to find super's probably still the way to go, rightly or wrongly. But those who have alternative options outside of super, investment bonds is certainly something to consider. Division
296 is a legislation the Labor government's bringing in, and it's. I think in essence it makes sense. I don't think anybody needs $50 million in superannuation to have a comfortable retirement. And if you actually look at the definition of retirement, they just want to provide a comfortable retirement income for people. Now, I can have a comfortable retirement income with $3 million in super and my wife having $3 million worth of super. That's pretty comfortable. But we do know of superannuation funds where people have got 20, 30, 40, 50, $100 million. Unfortunately, I think the way the government's gone about it is a little bit, it's a little bit nonsensical in that they're intending to tax unrealised gains. Now, this doesn't happen anywhere in Australia, and it happens very seldom throughout the world. There's been a couple of instances. But the idea that my superannuation balance will go from $3 million to $3.3 million, and I'll be taxed on that $300,000 balance over $3 million at 30%, even though I haven't sold it and realised the gain. Because the following year I could come down again. And what's going to happen is people who are in retirement are going to have to write a cheque to the government for that gain on unrealised amounts. Now, if I'm in retirement and I'm comfortable and I've worked out my income stream and I've done work with my financial planner to create a budget, and all of a sudden my financial planner rings me up at the end of the year and says, hey, you've got to write a cheque for $30,000 or $40,000 to give to the government.
Because that property in your self-managed super fund that you've got sitting there just went from 2.5 to 3.5 million. Hey,
that's right.
Paul,
now,
you've got to sell a bedroom, mate, because you've got to pay for your tax.
That's right. And there's 125,000 farms in Australia in superannuation. Who knew? But I'm a farmer. I'm probably not cash rich. The farmer down the road sells his property at a higher price. The valuer comes in, values my property at a higher price, and all of a sudden I've got to write a cheque. And I probably don't have access to the cash.
Correct.
So the tax on unrealised capital gains is an insidious tax, and it shouldn't be there. But it will mean that people will pull their money out of that superannuation. The other thing you mentioned is the indexation. There's about 80,000 people who are going to be impacted at the moment. The Greens are saying they want the cap at $2 million, which would take it up to 110,000. But if we don't have indexation and we continue to get strong returns from investment markets like we've seen the last few years, it's going to capture more and more people. And if you're a 30, 40, 50-year-old today, and you've made significant contributions to super over the years, you're going to smash that cap. And that wasn't what super was set out for. Super has been very successful. Australia is the 56th largest country in the world by population, but we've got the 5th largest savings per head. And that's because of superannuation. And that's made Australia a very strong country. Keating government that really put this together with Hawke really put something in place that was fabulous. But the more we tinker with superannuation, the less people have confidence in it. And if I was a 35-year-old today, I wouldn't be banking on being able to access my super when I'm 60 or 65 in a lump sum. As you said, there's going to be successive governments come in and tinker with it and make it less attractive, which is a real shame. Now, coming back to people who are faced with this problem today, nobody wants to be paying tax on unrealised gains. So if you do have that balance over $3 million, and the average person's age in this category, I believe, is 72 years of age, these people are going to want to take that money out of that and put it somewhere else. Now, where do they put it? Investment bonds are taxed at 30%, the same tax rate, but we don't have that tax on unrealised gains. If you're 72 years old, you want to be thinking about estate planning, perhaps, where you're going to leave some of your money to children. And if you've got $5 or $6 million in super, you're probably going to have money left over. So the investment bond ticks that box. No tax on unrealised gains, takes care of your estate planning needs, and it's just getting money out of that environment that you don't want to be in. And the crazy thing about this tax is the government's doing it to raise billions of dollars in tax revenue. But guess what? If everybody takes their money out of super over $3 million, they're going to make no money in additional tax revenue. So what they're doing is they're eroding the confidence in superannuation, and they're not going to make much gain on the other side, because all their numbers are based around the fact that they're going to collect this 30% tax. But financial planners like yourself are going to say to your clients, hey, take that money out, put some money in an investment bond, buy the kids a property, maybe upscale your own house, those types of things. So it doesn't make sense as a policy, particularly with a tax on unrealised gains, but certainly the focus will be back on investment bonds as an alternative. And the other thing which you mentioned a bit earlier on in the introduction was the death tax. Most Australians don't realise there's a death tax. I was talking to a good friend of mine whose mum's elderly in a nursing home, and I said, what are you doing about your mum's superannuation? And as we know, if you don't have a dependent, your children are over the age of 18 and your spouse has passed away, and you pass away with a chunk of money in superannuation, you're going to be paying tax on that somewhere between 15 and 32%, depending on the makeup of your superannuation. And I think that's one of the most important things for individuals to understand, even if they're younger. What are you doing with mum or dad's superannuation if they're elderly, and how are you going to avoid paying that tax? Because a lot of people think, hey, mum's got $2 million in super, that'll be great, but you take 15% tax out of that, it's a big chunk of money to lose. So that's something you've got to take into account as well.